Hello and welcome to our first quarterly webinar to kick off 2024. Today we'll be focusing on 4 key areas of discussion that influenced the quarter. I'll be chatting with individuals across our organization about the economic outlook, markets, and Wespath performance, the new SEC climate rule, and an expansion of Wespath's social values choice funds. And our Deputy Chief Investment Officer, Johara Farhadieh, will be sitting down with DGI, one of Wespath's asset managers, to talk about their investment in Super Microcomputer. This is a slightly new format to the webinar, and we're excited to share it with you. We hope that this new format will provide greater flexibility and therefore allow us to better hone in on the subjects that affect your organization, your investments, the markets, and our world. Thank you for tuning in. I wrote about the Magnificent Seven in artificial intelligence in a blog from early March. One theme was that AI is the 5th technology shift over the last 30 years. The first 4 were the PC, the internet, mobile, and cloud. And these were sea changes in our daily lives and in the markets. Just look at the size of the technology sector in the US. As you can see from this chart from the Man Group, it is difficult to estimate the impact from these technology shifts. The markets have underestimated the last 4 by an average of 38%. There is enormous opportunity in artificial intelligence, and we wanted to bring viewers some insights from one of our managers on this complex topic. Last week, Deputy Chief Investment Officer Johara Farhadieh sat down with Disciplined Growth Investors, or DGI, a Minneapolis-based asset manager that Wespath has partnered with for nearly 20 years. DGI is a small mid-cap growth investor who is one of the asset managers in Wespath's U.S. equity fund. Their discussion centers around Super Microcomputer. This California tech company is one of the largest producers of high-performance and high-efficiency servers. They also provide server management software and storage systems for a variety of tech-based markets. The demand for Supermicro's offerings has soared recently due to the rise in popularity of artificial intelligence. Super microcomputers are revolutionizing how we process data and tackle complex tasks. Their compact form factor contradicts their immense capabilities, making them indispensable in a variety of applications. However, as is the case with any investment, it's important to understand both its strengths as well as the associated risks. With this backdrop, I turn it over to Johara and DGI.
Hi, I'm Johara. I am the incoming Chief Investment Officer here at Wespath. I'm thrilled to be joined today by Rob Nicoski. He's the Chief Investment Officer of Disciplined Growth Investors, also known as DGI, which is one of Wespath's external asset managers. Rob, thank you for joining me today. How are you?
I'm doing great, and Johara, and thanks for having me. It's my pleasure.
Absolutely. So I asked you here today to talk to you about a hot topic, one that many of our investors are interested in and excited about, which is AI companies, artificial intelligence. Specifically, I wanted to talk to you about Super Microcomputer, which is one of DGI's largest holdings at the end of the first quarter. Supermicro, which is what we call it for short, but Super Microcomputer certainly caught our attention because the stock tripled in price in 2023. So we're eager to hear about this company from you. So
Awesome.
With that, my first question to you is, what does Super Microcomputer make, and how has it benefited from the enthusiasm in AI?
Sure. Yeah. So Supermicro is a leading provider of high-performance servers. And their servers are used to run a broad range of compute-heavy applications across both internal data centers and cloud data centers. In recent years, a growing portion of their revenues has been generated from the design and manufacturing of tightly integrated racks of servers. And these racks that are integrated ostensibly act as one big supercomputer. And these systems are really purposefully designed to support increasingly computational intensive workloads. So let me give you an example. The latest iteration of large language models like ChatGPT-4, they have reportedly exceeded 1 trillion separate parameters that they're calculating, which is really mind-boggling when you think about it. And as you might imagine, incorporating that many parameters into a model requires highly accelerated compute capabilities. That's something that Supermicro really excels at. And so because of their emphasis and expertise on being able to manage these compute-intensive applications, they've been a clear beneficiary of the surge in demand for AI-oriented technology and the infrastructure build-out of AI. And also, I would add that the impact of AI on Supermicro's business can be seen in the company's financials. You mentioned it tripled in 2023. If you look at over the last 2 years, Supermicro's revenues have more than doubled, and their EPS has quintupled, thanks in part to the surge in demand for AI. And if we look at their last quarter, we estimate that more than 40% of their sales came from AI-related installations, and we would suspect going forward that you'd probably see even more than that, just because of the demand that we're seeing for AI infrastructure spending.
Yeah. So what sets them apart from their competition? What makes Supermicro so successful?
Sure, that's really the key question from an investment perspective, because the company's competitive differentiation, as you know, and its ability to sustain it is a primary driver of long-term value creation. Our work suggests that Supermicro has a few points of important points of differentiation. First off, as I alluded to, they offer superior computational performance, and they also offer the lowest cost per compute. Usually the market leader in performance is not the low cost provider as well. So this is a pretty rare and powerful combination that underpins their competitive advantage. Second, they offer the most flexible solution in the industry. They developed a building block architecture that allows hundreds of different configurations for their clients. And this, let me give you an analogy here, maybe. And perhaps the most apt analogy is Lego blocks. I think we're all probably familiar with Lego blocks. And if you think of Supermicro's solution as a large set of Legos with a variety of different colors and sizes, and you can build just about anything out of a set of Legos like that. And you can contrast, if you think about their major competitors, Dell and HP, as the equivalent of a set of Legos that are all one size and one color. Still fun, but not as versatile. And thirdly, they're far more energy efficient than their competitors. State-of-the-art Supermicro installation can consume up to 40% less energy for the same level of compute. Now, 15 or 10 to 15% of this roughly comes from their superior engineering and design capabilities, while another 25 to 30% of that advantage is available through their liquid cooling. And Supermicro offers the only scalable liquid cooling solution available in the market today. And this is important because the power requirements for an AI data center can be 10 times that of a traditional data center. And one last one, the quality and depth of their technology partners is really differentiating as well. The most important of which are the semiconductor manufacturers, in particular NVIDIA, Intel, and AMD. Because engineers with those companies work very closely with the engineers at Supermicro and have for years.
Definitely familiar with Lego blocks in my house. I have a 7-year-old that's obsessed with Legos and a 1-year-old that wants to put all those Legos in her mouth. So definitely understand. So tell me a little bit about DGI's exposure. So when did you guys start investing in Supermicro, and what was it that initially caught the analysts' eyes in order for you guys to make this investment?
Sure. We actually made our first investment in Supermicro more than 12 years ago. So we like to call investments like Supermicro's our 10-year overnight successes, because oftentimes it looks like from a stock standpoint they're not doing anything, but under the covers we're seeing the progress. So when we look, if we flash back to that time period, there are a few attributes of the Supermicro story that really captured our attention all those years ago. One was they were selling into a massive market. Conservatively, servers are a $100 billion market, and Supermicro's annual revenues at the time of our initial purchase were right around $1 billion. So there was obviously plenty of runway to grow the business. As an aside, I would add that the CEOs of AMD and NVIDIA have said that they think the market for servers will ultimately exceed $400 billion per year as AI workloads continue to proliferate. If they're right, there's a lot of runway to go yet. The other thing that we liked about Supermicro back then was that they offered a clearly differentiated solution, and as I already alluded to, in a market dominated by commodity products. So they offered a modular, high-performance server option, and as I said, I know it's less expensive, by the way, as well. So, and what they didn't have at that point in time was a recognizable brand. But we believe that over time, the superior value proposition would solve the brand awareness issue and allow them to capture share. And the last thing that attracted us was the founder, Charles Yang. He had and still has a tremendous clarity of vision. So he's always thinking about building the company for the next 10 to 20 years, not the next 10 to 20 months. And Charles also owned at that point in time and still owns a big chunk of the company. I think he still owns over 11% of the company. So he's well aligned with external shareholders.
That's great. So recent news is Supermicro replaced Whirlpool in the S&P 500. What is the significance of this?
Sure. In one sense, entering the S&P 500 is validation of exactly what we are trying to accomplish in our investment process. And let me tell you what I mean by that. Because our goal is to buy, at a very simplistic sense, smaller and medium-sized companies that have a high potential of really becoming big companies over time. And this is a recipe for creating tremendous shareholder value. So entering the S&P is one sign that Supermicro is in the process of making this transition. But I want to be clear, we think it still has a lot of room to grow. It is by no means a mature company like Whirlpool, which I think is probably where your question was going. Supermicro still has a small share of a traditional server market, and we are likely in the first inning of the build out of the AI infrastructure. And one other thought I would add, a leading AI infrastructure company replacing an old line consumer durables manufacturer in the marquee index is also probably a good signal regarding where the exciting investment opportunities are in the economy.
And speaking of exciting investment opportunities and where we are today, are there any other companies that you are invested in that are benefiting from the enthusiasm around artificial intelligence?
Sure. Yeah. I'll highlight two in particular that are kind of right in the center of this right now. One is a company called Pure Storage. And we know that all AI models are only as good as the data they are trained on. So this means any organization looking to leverage AI needs a high performance data storage solution, one that allows for effective ingestion of all the relevant data into an AI training model. Pure Storage provides such a solution. Pure's solution is fast, it's reliable, it's easy to implement, and it provides the ability to see and manage data across data silos, both internal data centers and in the cloud. And additionally, when you think about the importance of storage, slower, unreliable storage solutions are costly because it means very expensive GPUs are being underutilized. So, and even though AI use cases are still a small part of Pure's business right now, several hundred of Pure's customers are piloting different AI applications. The second one I would mention is a company called Arista Networks. So Arista designs high performance network switches, and their switches are preferred by many of the hyperscalers like Microsoft and Meta, who are both very large customers of AristaNet. And their switches are used in DCs of thousands of other large enterprises as well. The company switches, and they take their switches and they layer on top of that to a proprietary OS. And the combination of the two provides for high bandwidth, low latency network communications. And these are two attributes that are critical for large scale AI applications. So this ability to move data efficiently and reliably helps to optimize the use of the compute infrastructure, and it speeds times to market. Now, in the case of AristaNet, they don't break out their AI related sales specifically, but we suspect it as a material portion of their sales and rapidly growing. And if I could, one last point just to put a bow around this, I'd like to point out that Supermicro, or like Supermicro, I should say, we have owned Pure and Arista for years. We didn't buy them specifically for the AI opportunity. We purchased them because they're serial innovators and disruptors within their respective markets. And because of that, they're positioned to benefit from the growth in AI.
Well, thank you so much, Rob. We hope that you guys continue to find those serial innovators and disruptors for our portfolio and our investors. So I appreciate you taking the time today to let us know a little bit more about DGI and Supermicro. Thank you.
You're welcome. Thanks, Johara.
Thanks for joining our quarterly webinar, Dave. Let's start with U.S. economic growth, which once again has confounded most professional economists.
Thanks, Joe, and welcome to our viewers. I'm happy and pleased to share my thoughts on the U.S. and world economies and markets.
So, Dave, 3 months ago, during our quarterly webinar, you displayed this slide showing the consensus view of about 70 professionals interviewed by the Wall Street Journal. With the Atlanta Federal Reserve forecasting that the U.S. economy grew at 2.5% for the first quarter, have the experts made any adjustments to their predictions?
Indeed, Joe, the Wall Street Journal panel got it wrong in 2023, and it looks as though they are getting it wrong again this year. As I mentioned during last quarter's webinar, the panel expected zero growth and a probable recession in 2023. The U.S. economy, however, produced stellar performance with real economic growth of 3.1% and no recession in sight. Now, coming into 2024, while not as pessimistic as they were at the beginning of 2023, the economists collectively felt the U.S. economy could grow no more than 1% for the year. But as you pointed out, Joe, it looks as though first quarter growth exceeded 2%. I've updated the chart you showed earlier with the most recent estimates from the Wall Street Journal panel. They now believe that the economy will grow at 1.7%, which is a bit lower than the long-term averages. What's more, the solid economic growth the United States is seeing is much better compared to the rest of the developed world. This next chart is one that you saw and posted to our internal Teams channel. It compares the evolution of economic growth estimates for the US and 4 other countries and the Eurozone. A year ago, global economists surveyed by Bloomberg predicted that the countries of the developed world would grow between 0.5% and 1% in 2024. And as our viewers can see on this chart, while economists have steadily increased their predictions for the U.S. economy, they've decreased their forecast for the rest of the developed world to between 1/4 and 3/4%.
So strong U.S. versus slower developed world growth has been a popular topic with our investment team. So why do you think that is, Dave? What is it about the U.S. economy that is so different from the rest of the developed world?
So I've read about several different reasons why growth continues to exceed expectations for our economy, as well as growth rates for other countries. First, U.S. government stimulus, both past and present. In addition, both the Infrastructure Bill, otherwise known as the Inflation Reduction Act, and the CHIPS Act have provided additional economic stimulus. Second, consumers continue to spend despite depleting savings and increasing relying on credit for purchases. We collectively developed spending habits coming out of the pandemic, and we've been slow to cut back on our spending levels. Third is the impact of immigration. Long term, there are only 2 factors that account for economic growth: an increased labor force and increased productivity. We know that the native-born population is shrinking, and the foreign-born population increased significantly over the past several years. Speaking of productivity, a fourth explanation could be the contribution of generative artificial intelligence and its impact on productivity. That game is still in the very early innings. I can attest to how the various chatbots have helped enhance my own productivity, and I know that I've just scratched the surface. I do believe that a small portion of the growth we are currently seeing can be ascribed to advances in artificial intelligence, though I should note that productivity enhancements from AI would not be something that's unique to the U.S. economy. So, Joe, why do you think the U.S. is doing so much better than the rest of the world?
Yeah, so Dave, I agree with all your points on how the U.S. has managed to maintain its growth versus the rest of the developed world. The point I think is somewhat scary is the level of stimulus, because the stimulus won't last. And when it abates, we could see more even growth between the U.S. and the rest, at least, of the developed world. So one big picture theme that we talk about all the time is that the United States, we have oceans to the east and the west, and we have friendly neighbors to the north and south. The United States also has all its own natural resources, whether it's food, oil, minerals. And while we're still dependent on foreign manufacturing, you mentioned the CHIPS Act, we're starting to reshore. So we have a lot of advantages that are just very natural to our geography. And it might be worth considering some of the differences compared to other parts of the world. So I think about, for example, Europe and Japan. Europe is an old economy, both in terms of its population, and Europe's old in terms of the kinds of businesses that exist there. And if you look at the S&P 500, we look at about 40% is in the technology and technology-related sectors. Europe is about half that. Japan slightly more than 20%. But then the U.S. clearly is benefiting from these large companies and technology companies, and like you said, that on the generative AI. And I think that thinking about Japan, one could argue that their stock market started with their rally, I should say, started with the structural reforms, but also a really sharp weakening of their currency. So all that being said, do you think that the U.S. can continue to lead the world? And if so, how long?
So while I agree with most of your thoughts, Joe, I'm a bit pessimistic about the extent to which the U.S. can continue to outperform the rest of the world. What worries me is growing debt burden and the costs associated with servicing our rising debt levels. So let's take a look at this next chart. The data that comprise the chart on the left is taken from the International Monetary Fund's most recently published World Economic Outlook. It compares the history and the IMF's projections for debt as a percentage of our economy, GDP, for both the United States and the European Union. While we saw meaningfully increases in debt levels for both the US and Europe coming out of the great financial crisis of 2008-2009, the Europeans gradually lowered debt levels until COVID hit and are projected to continue reducing debt levels for the next 5 years, absent any unforeseen crisis like the GFC or COVID. Yet the trend for US debt levels continue to drift higher. Now on the right, we can see that debt service costs have skyrocketed and exacerbated by increased interest rates. The federal government's interest costs on the debt now surpasses a whopping $1 trillion a year, or around 15% of the total US budget. I would argue that economic growth cannot be sustained if we continue to pile up debt and interest costs. Taxes will inevitably have to rise, which will certainly have a dampening effect on economic growth.
So that's a good segue to what the next topic of interest for our viewers, and that's the Federal Reserve's plan for lowering interest rates. So let's take another look at your earlier slide showing the change in economists' expectations for 2024. At the beginning of the year, the consensus view was that the overnight Fed funds rate would drop to 4.25% at the end of this year. And as I think many of our viewers know, the Fed funds rate is the overnight lending rate for surplus bank reserves loaned to other financial institutions. It influences the interest rate charged throughout the economy. As we've discussed in the past, high interest rates, in theory, are supposed to slow the economy down, resulting in higher unemployment rates or lower rates of inflation, or both. The Fed targets an annual inflation rate of 2%. If inflation rates are higher, the Fed will increase rates until it has slowed economic growth and its target rate of inflation has been reached. But with continued economic growth, and now including low unemployment, and inflation remaining stubbornly above 3%, the market optimism for 3 or more rate cuts has diminished to maybe 2, and one Fed official suggesting we might not have any rate cuts until 2025. So just last week, we saw that the inflation rate inched up higher than the prior month, which further decreased the likelihood of any rate decreases. So what are your current thoughts on inflation, Dave? Do you think that inflation rates will approach the Fed's target at 2% anytime soon?
So I remain less than optimistic, Joe, that inflation rates can breach the 3% level for much of the rest of the year. First, as we've talked about, consumer spending remains strong, which puts upward pressure on prices. Second, we've seen a recent spike in energy prices. Oil prices are up over 20% since the beginning of the year. Though the Fed looks at inflation numbers that exclude oil price shocks, reality is that higher energy prices influence the cost of producing the goods and services that the Fed does factor in its inflation calculus. Third, we've seen unusual spikes in things like auto insurance and hospital costs, which are adversely affecting the inflation numbers. Going back to the Wall Street Journal survey, economists appear less optimistic compared to the beginning of the year that inflation will close in on that 2% goal.
So I guess that's another way that we differ from the other developed countries. Last week, the Statistical Office of the EU, or the European Union, reported that their annual inflation rate fell to 2.4% in March. On cue, the financial community expressed increased levels of optimism that euro area interest rates were going to have cuts in the near-term horizon. Their report showed that energy prices declined 2%. Much of the decline is attributable to the drop in natural gas prices. Last October, the price of natural gas in the euro area reached a high of nearly the equivalent of $60 per megawatt hour. Prices have dropped to less than half that amount, which is still significantly higher than what US consumers pay for natural gas. If the European Central Bank lowers its lending rate and our Fed maintains rates, we should think that a stronger US dollar and higher interest rates, because the higher US dollar because it would attract higher interest rates. What are your thoughts on whether the stronger US dollar is a positive or negative for markets?
Well, while a stronger dollar may provide a psychological advantage, let's not forget that it also means that products and services offered by U.S. companies are less competitive compared to their foreign counterparts. And we will lose business to the cheaper goods and services that are produced outside the United States. And as you recently reminded me, Joe, historically, the global markets have tended to perform best in periods where the dollar is somewhat stable and weakening.
That's true. So it'll be interesting to see what the data reveals over the next several months and how the Fed reacts. So let's move on to business conditions, Dave. How have business conditions changed for the first 3 months of 2024?
All right, so let's first look at the monthly survey of purchasing managers. Each month, the Institute of Supply Management poses a series of questions to company purchasing managers. The first question is, are business conditions better or worse than last month? A score of 50 means that half the respondents said yes and half said no. Hence, a number better than 50 means business conditions are positive. Less than 50 means they are not. As we can see on the chart on the left-hand side of the next slide, business conditions for manufacturing have been not so good since November 2022. However, in March, manufacturing conditions turned positive. On the right side, we see the responses from purchasing managers of companies in the services sector. There we have seen a steady decline in conditions, but they are still positive. So overall, business conditions look pretty good. What's more, the profit picture for large businesses continue to improve. As you can see in the next chart, the S&P 500 experienced solid earnings growth in the second half of 2023, and analysts are forecasting continued growth into 2024 and 2025. The forecast of about 2.5% growth for the first quarter would be significantly better were it not for 20% plus earnings declines in the health, energy, and materials sectors.
As I understand it, Dave, the ISM surveys is the corporate purchasing managers of larger companies. And this last chart you showed shows earnings growth for the S&P 500 largest companies. So what about small businesses? They're the backbone of the economy. Are they also experiencing positive business conditions?
Well, Joe, I wish I could say that small businesses were flourishing, but that's not the case. This next slide displays the results of a monthly survey of small businesses, and we are continuing to see a steady deterioration in their level of optimism. In fact, small businesses today are less optimistic than they were at the nadir of the pandemic, the worst reading in over 11 years.
So why do you think that is, Dave?
Well, according to the National Federation of Independent Businesses, which conducts the survey, small business owners are reporting that they are increasingly adversely impacted by inflation. They've seen their profits squeezed as labor and supply costs are increasing more rapidly than the prices that consumers are willing to accept for the products and services that the small businesses provide. In addition, they've had difficulty borrowing money at interest rates that they can afford. This latter point is definitely a direct result of the Fed's interest rate policies that we discussed earlier.
So Dave, before we wrap up, is there anything you'd like to add regarding international markets?
As we noted earlier, Joe, economists expect tepid growth for the rest of the year, though inflation is cooling faster than here in the U.S. Manufacturing continues to be weak in the developed world, though on fire in India, now the world's most populous country. In addition, like the US this year, many countries will be conducting national elections, which adds to the uncertainty. Compound that uncertainty with conflicts in the Middle East and Eastern Europe.
So Dave, speaking of the election, are there any thoughts about the U.S. election that may influence the markets?
Not really, Joe. I suppose a landslide by one side or the other could have a significant impact on certain market sectors. For example, if we saw a Republican landslide, one might expect a significant upward move in the oil and gas sector. Conversely, a Democrat landslide would be positive for the renewable energy sector. But as you mentioned earlier in the week, Joe, one of our asset managers has frequently reminded its clients that elections have not been big drivers of returns overall, and I honestly don't expect that it's going to be any different this year.
Well, Dave, thank you very much for your thoughts, and thanks for joining.
Good to be here.
I'm joined now by my colleague Karen Manczko. Together we'll be discussing both markets and Wespath fund performance. Regular viewers might know we've talked about these two themes separately in past webinars. We've decided to combine these two segments together this quarter. We think the conversation should flow nicely and certainly welcome any feedback on themes to cover in future quarters. With that said, Karen, how did the first quarter treat you?
It's a great quarter for the markets and for our alma mater, the University of Illinois. For our fellow Illini fans and followers, the Illini made it to the Elite Eight in the NCAA tournament for the first time since my senior year at the University of Illinois, which was almost 20 years ago. Joe and I both attended the University of Illinois for our undergraduate degrees and obtained our MBAs from the university, which is why we are proudly supporting our alma mater as we give today's update.
It was certainly a quarter to remember for Illini fans, and as you mentioned briefly, it was also a quarter to remember for the markets. This was the best quarter since 2019, with 22 record highs for the S&P 500. You can see at this chart on the right, we've been looking for quite a run for the S&P 500 since October of last year. The S&P 500 was up 10% on the quarter, and the unexpected part was this happened even as the yield curve moved higher.
That is unexpected because the markets have been following the yield curve, and we have a chart to show this divergence. You can see that from this chart on the left that the S&P 500 moved higher even as rates moved higher, a clear change from the past several quarters. Also, the market's not pricing in higher earnings. So again, this is a new shift in paradigm. You can see this on the chart on the right.
Yeah, you can see that this post-COVID cycle is unique, and many of the past correlations are just not holding up. And we continue to work through the $6 trillion in liquidity and the impacts that we're still feeling today. So looking at equity market returns broadly, you can see that the large cap names, the 50 largest names, they continue to lead the market, but we're seeing the rest of the market playing catch up. So Karen, what are your thoughts?
So for the past year and a half, returns have been led by the mega cap stocks. And we all know this as the Magnificent Seven and their strong 2023. But in 2024, you can see that the S&P 500 and the mid-cap index were close to the Russell Top 50. And we use this index, the Top 50, to measure our mega cap weighting in our U.S. equity fund. Small caps, shown by the Russell 2000, lag the broader index, which is expected with expectations for higher rates, and this can really dampen those asset class returns.
And I'd add that international stocks, shown with the MSCI EAFE index, and emerging markets continue to lag the returns of the U.S., but to a lesser degree than previous quarters. And valuations in international markets remain significantly cheaper than in the U.S. So with that said, how did Wespath equity funds perform in Q1?
Let's start with the U.S. equity fund. Net of fees, we underperformed slightly due to, again, that underweight to mega cap stocks, given that the Russell Top 50 was one of the best performing asset classes. A contributor to the fund performance was stock selection by our active managers, specifically one of our managers, DGI, who had strong performance in the first quarter due to their stock selection. Tune in to the rest of this quarter's webinar, and you'll see an interview between DGI and our deputy CIO, Johara. Private equity was a slight drag as expected because the public markets were higher. Exclusions were slightly positive as Boeing was down 26%.
So looking at the international equity fund, we underperformed by about 1.6%. And I was looking at the fund's performance and noticed that the last 3 years have been especially difficult for active managers. And our managers, particularly with growth names, have lagged the benchmark.
Yes, while the fund had positive for the quarter, we did lag the benchmark. Stock selection by our active managers was a detractor to the fund performance. Also, similar to the U.S. equity fund, private markets were a detractor given the strong public market and these valuations lag. It's also important to note that the fund's emerging market exposure, China in particular, was a drag. And they're roughly flat for the quarter and lagging for both the U.S. and developed markets.
So let's switch to fixed income. So we talked earlier about the shift higher in the yield curve, which was certainly unexpected in 2024. The Fed basically signaled that they're done hiking rates in the fall, and the markets were looking for a slowing economy and slowing inflation. How did that work out?
Well, the economy remains more resilient than expected. GDP grew at 3.2% for the fourth quarter of 2023, and the Atlanta Fed forecast 2.4% for 2024. Inflation remains stubbornly above the Fed's 2% target, which at an annual rate of 3.5% as of March, which was the highest it's been in 6 months. So since this number has not come down, the market continues to roll back Fed rate cut expectations. We've gone through from 7 rate cuts in January to just 1 or 2 now that's expected in 2024.
So with rising yield curves, we should expect lower bond returns. And I think that's exactly what we've seen. So looking at the broad bond returns, the U.S. aggregate was down about 78 basis points and the global aggregate by 1.5%. And the inflation-linked index was largely flat. But since high yield in emerging markets outperformed, I would assume that Wespath fixed income funds also outperformed.
Yes, Joe. The Wespath funds outperformed benchmarks for the first quarter. In the fixed income fund, we outperformed by 30 basis points and 1.5 percentage points over the past year. Our overweight to credit and high yield and underweight to treasuries was the main driver of the performance, along with strong issue selection by our active managers. The Inflation Protection Fund was slightly below its respective benchmark. The out-of-benchmark allocation to commodities was a contributor to the performance. The fund's non-dollar exposure, however, detracted as we saw the dollar strengthen in the first quarter relative to other currencies. So as we pull up to the multiple asset fund on this next chart, here we have the multiple asset fund composite versus a balanced fund peer comparison. You can see on the screen that the multiple asset fund performed how it performed relative to other balanced funds currently on the market.
So thank you for that, Karen. And we have some exciting announcements for our viewers, correct?
Yes, we do. As you and Lucas will cover in one of your sections, we recently announced that we will be launching our Social Values Choice suite of funds to our I-Series investors. So if you want to learn more about that, tune into your section with Lucas. And also there's some information on this slide.
All right, and I have one final topic for our viewers. This chart shows the returns at the end of a Fed hike cycle, as shown by JP Morgan. On the left, it shows data since 1980, what happens in the 12 months prior to the Fed rate hiking cycle, and then the following 24 months after. And you can see that the stock market usually starts to rally before the last Fed rate hike as the economy is improving. And with the exception of 1999 to 2000, the dot-com crash, markets largely are higher in the subsequent 2 years after the Fed rate hike. And on the right is the 10-year bond. And again, you can see that the following 2 years after a rate hike is done are generally positive for bond markets also.
So really to summarize for our audience, prior to market cycles, when the Fed has indeed done their hiking or increase in rates, then we can expect positive market returns.
So Karen, yes, we can always have an external shock, and historically markets will react well to the end of a Fed rate hike cycle. Time will tell if that pattern continues, but with that, I want to thank the viewers for tuning in. Please reach out to us with any questions. I'm now joined once again by my colleague, Lucas Schoeppner, who helps manage our investment stewardship and engagement activities.
Thanks, Joe. Great to be chatting with you again.
So Lucas, we know you spend a lot of time on environmental themes. In last quarter, we talked about methane emissions and how they can affect the oil and gas industry. This quarter, we've got some news out of the SEC with released proposed rules around climate reporting. What is all this rulemaking about?
Well, this proposed rule calls for uniform disclosure of Scope 1 and 2 emissions for most large publicly traded companies in the U.S. So this scope 1 and 2 emissions means companies' direct emissions and emissions close to that, like things from vehicles run by the company or travel emissions. And the reason why investors care about these emissions is because these standards will make it easier to compare apples to apples between companies when it comes to finding who's operating most efficiently or who's operating with the least carbon footprint. For a lot of companies, they look at these carbon emissions as waste, as energy costs, as overhead that they're looking to cut when they can. So we also hope that this will help investors like Wespath, who might have carbon reduction commitments or net zero commitments, also measure the impact of their own portfolios more accurately. Now, over the past decade, it's become an expectation amongst many investors that companies will disclose their carbon emissions and incorporate climate risk into their business strategy. But what this rule does is kind of set a baseline for companies to report those direct emissions when they're financially material and when external climate risks like flooding or extreme weather events have a big enough potential impact that they're worth reporting to shareholders.
And so from what we've heard, that these proposed rules have changed a lot since the initial drafts. Do you agree with that?
I do. A lot of advocates from both the investor and NGO space hope that these rules would include mandatory Scope 3 emissions reporting too. Now, Scope 3 emissions means reporting beyond those direct company emissions we talked about a minute ago. So this means things like for a textile manufacturer, the emissions that are in their supply chain upstream, or for an oil and gas company, the emissions that come from the tailpipe of a car. And this is important because, for example, in that oil and gas sector, tailpipe emissions can mean up to 80% of a given company's carbon impact.
And it sounds like there's been a lot of pushback from both sides of the aisle around this proposed rule.
That's right. This rule excludes those reporting requirements on Scope 3 emissions that was in there in some earlier drafts of the rule and was later on taken out. A lot of the investors and advocates who are more focused on climate change were really disappointed to see that that was taken out of the rule. But at the same time, some companies and investors, maybe on the more conservative side of things, are also arguing that climate change and risks around that just aren't something that should be under the purview of the SEC in the first place.
And so, Lucas, what do you think this rule could mean for the companies we invest in and the kinds of disclosures that we see from them?
Well, ideally, it's not going to mean much at all because most of these companies are already reporting their Scope 1 and 2 emissions already. Now, we have seen a lot of what's called for in these SEC rules involve a lot of caveats around materiality. So we'll keep an eye on whether some companies backtrack on that. But for the most part, what's being called for is already being addressed in annual sustainability reports. The truth is that this kind of standard is going to make it easier for Wespath to move on to other engagement priorities just beyond disclosure on things like carbon emissions. And that'll hopefully allow us to better manage risk in our clients' portfolios.
And Lucas, there was some breaking news recently when the SEC announced they would pause the implementation of some of these rules. Companies and trade groups complaining that there was immediate and irreparable harm from the regulations. And you mentioned earlier that there's some concern that they're already overstepping their bounds. So can you comment on this?
Sure. So, as you mentioned, the SEC on April 4th told the U.S. Court of Appeals for the Eighth Circuit that it would stay the requirements for public companies in the U.S. to report these carbon emissions and carbon risks that are called for in the proposed rule. But we're hoping that this doesn't have a major impact on the implementation of them. The SEC has never really been on the vanguard of climate disclosure. Their job, in my view, has always been to kind of set the basic standards, set in stone what's already starting to take place. So this they've done since 2009, when they started to call for climate risk disclosure in annual reporting. In my opinion, they're setting a floor and not a ceiling, and this is an important role that they play here. And we're skeptical of the supposed harm that these rules would mean for companies because most of this reporting, as I mentioned, has been done for years anyway. And there is still a lot of uncertainty still around what good Scope 3 emissions looks like, those supply chain emissions that we talked about earlier. But we hope this rule will still be implemented, and I think it will help make these climate reporting standards a permanent fixture of reporting in the U.S., and it'll just be consistent with the kind of voluntary sustainability reporting that we've seen in the U.S. over the past 10 years.
And so, Lucas, so one last topic, an exciting one. Can you tell us a bit about the expansion that are coming to the social values choice funds and particularly for institutional investors and for investors that are preferring an approach that avoids investments in fossil fuels?
Sure. So while we believe keeping our seat at the table and making the Methodist voice heard on issues of climate and policy is really important, we're pleased to announce that the expansion of the Social Values Choice Fund is upcoming. This will come to institutional investors by the end of the year. These funds don't invest in companies that derive a significant amount of revenue from companies involved in the fossil fuel industry. And these enhancements aim to empower participants and organizations served by Wespath to align their investments more closely with their individual values.
It's exciting news. Lucas, certainly thank you for coming today.
Thanks for talking with me, Joe.